Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Fadakia. Hey Hormuz, good morning. Before I talk about the markets, it's finally Friday. It's been a long week with a lot of updates that we've been talking about, but looks like even the Nifty is tired. It's a 100-point downtick on the Nifty as we speak after touching that 52-week high level yesterday. It was a day in the green yesterday. Most of those gains have been pared down today. 100 points down on the Nifty. We have recovered from the lows of the day, but still deep in the red. The mid caps also down around 0.8%. This index is underperforming the benchmark. And what is leading to these losses in the Nifty? The Nifty Metal Index, which is down 1.5%. We have the PSU Banking Index, which continues to be under pressure. That index is down 1.2%. Financials not doing so well as well. Some sectors in the green, though. The Auto Index, we'll discuss a lot about it in greater detail. We have the consumption names, which are a wee bit in the green, supporting the Nifty from the lows as well. However, mid-caps continue to be on our radar. The advanced decline ratio is in favor of declines by a big margin, and the small-cap index too under a lot of pressure. So let's go across to Hormuz. He's here with us and putting spotlight on the top movers in the market. Hormuz, what do you have on your radar?
Well, Friday there is fatigue across the board, but there are some stocks that are showing no signs of fatigue, and the potential beneficiaries of an impending India-US trade deal continue to be in the spotlight. We spoke about Avanti Feeds earlier in the week. Today is the turn of Apex Frozen Foods, and that stock has now snapped a two-day losing streak today, 13% higher on this stock. And we've had volumes worth close to 14 lakh shares that have already been traded on the stock. The 20-day average here is less than 2 lakhs, so almost well over 7 to 8x of its 20-day average. This is turning out to be the third straight month of gains for the stock, and considering this third 3-month rally, the stock has turned positive on a year-to-date basis and is now up 10% for the year. The other one on our radar is Magnelic Cloud, and we don't talk about this stock quite often. 9% higher today and is now seeing a rebound after the stock fell to a 20% lower circuit yesterday. We have had almost 80 lakh shares that have been traded. The 20-day average is 9.5 lakh shares, so 9x its 20-day average. As a result of that 20% fall yesterday, the stock fell below all of its key moving averages yesterday, and it continues to remain so. And the stock has been down for 4 months in a row now, despite this rebound that we are seeing today. And on a year-to-date basis, the stock's down around 25%, was down another 20 in 2024 as well. The stock that's making a move today is M&M Financial, and that stock is seeing some choppy moves today. At one point, a few minutes ago, the stock was up around 1.5%, and it's now gained in 4 out of the 5 days this week. But despite this choppy move today, the stock has gained over 12% this week, and it's turning out to be the best week that the stock has had since February of 2021. And today's session had 40 lakh shares traded already. The 20-day average is 10 lakh shares, and on a year-to-date basis too, the stock is up close to 40%. It's turning out to be the best year that the stock has had since 2022.
All right, some interesting names there. Thank you so much, Hormuz, for joining us with that list. Those are some buzzers on our radar today. But let's move forward and talk a lot more about markets as well. Rohit Srivastava, who is the founder of India Charts and Strike Money, is joining us now to discuss the technicals, the top sectoral bets, and a lot more. Rohit, good morning. Thank you so much for joining in. What's happening with the Indian markets? We are not following what's happening globally. But do you think there is a support that the traders should be watching out for? What are the next important levels in the Nifty that you're targeting?
So we've seen our market diverge, I think, from the rest of the world for quite some time. And interestingly so, unlike last year, we are diverging on the way up and not on the way down. Both in October, when the US was seeing a correction, we didn't fall too much. And I think we are seeing the same thing now. Last week, we were a bit off. Again, we've taken off to a new high in the last 2-3 days. Today, I think we are taking support close to 26,000, 26,050. Those are intraday support levels. If those continue to hold, I think we should continue to march forward in the coming week. First to, of course, get past the all-time high, which is 26,270. But eventually, I think we are headed towards 26,800 in the coming weeks. And that is where I think we'll be headed. So all-time high is not very far. I think they are coming. We just need to hold this support intraday for the day. We will also be closing positive for the week, if you notice. So even though there is some intraday weakness, the weekly charts are also going to continue to look good.
Rohit, morning. Thank you for joining in. You're saying all-time highs continue in the next few weeks, but the big contributor to this move that the Nifty has had from levels of around 24,500 to where we currently stand has been the Nifty Bank. And there was conversations about the index going towards 60,000. It's very close to that now. What next for the Nifty Bank? The longer period charts, does the index take a bit of a pause once it gets to 60,000, or do you see those levels still being some time away?
I think 64,000 is what we still have on our charts. So that doesn't change. This is just, I guess, some near-term pullback because it's been a performer. It's also hit all-time highs ahead of the Nifty. So it calls for some correction pullback. Will it be significant is a little early to say. I think the key support, the initial support is going to be at around 58,600. So if that doesn't break, we are all good. If that does, then it's possible near term you do see a further setback in banking relative to the market. But something to keep in mind is that our market's always been about rotation. We've seen different segments of the market do well, others pull back, then others do well. And I don't think that is going to change anytime soon. So we shouldn't be too worried that, banking that has led the way so far pulls back. Something else that has already pulled back can lead the way again. And there are many, many leaders that we have, in the market.
Hmm. Which are the other sectors you think could lead the markets from here on, Rohit? Is it purely based on technical terms, or do you think the fundamentals are leading to that up move that you'll see going forward?
So it's a mix of both. On the technicals, I think interest rate sensitive sectors are anyway looking good, which is your autos and metals. So the metal sector, for example, has already pulled back in the last week or two, and we are back to close to the 40-50 week averages, which are good supports for another leg up to start. This would also end up getting supported not just by the rate cycle, it would also be supported by probably weaker dollar. It has been heading up for a while. But I sense that as the US rate cuts get closer and closer, the US dollar will start, ticking on the other way, and the commodity cycle picks up again. We've already seen prices of aluminium, zinc, and even steel more recently starting to pick up. So those are good signs that the underlying current in the commodity prices is there with us, and that is why I think metal stock should do well. Autos, of course, there have been multiple triggers from tax cuts, GST cuts, and the rate cycle. All of that comes together. And I think it's few of the indices which is positive today. So it is holding out. The others, I think, would pick up as well as time goes.
What about IT, Rohit? It's been the yo-yo or the ping-pong ball in all of these global developments. Anti-AI trade, pro-AI trade. With the US not doing well, India does well, and vice versa. Would you stay away from a sector like this, or do you believe that the correction has been good enough to give you an attractive entry point?
So there are two parts to IT. One is the trade and one is the investment. So as a trade, I think it got oversold. It's already reversed, and we are putting out some trades on some of the IT stocks. But the upside may be limited to that 5-10%. The IT index goes up to a 40,000, and then how much more? The problem really is that when you take a 1 year, 2 year outlook, then you're going to have a very, very different view of things. Which stocks would you really want to be in? And my answer is I'd rather buy growth stocks that are growing earnings at 40-50% and are available at a PE ratio of 25 to 40 than end up with an IT sector which is growing earnings at 5-6% and is behaving more like a defensive sector. So you're not going to get those multi-bagger big return outcomes from IT. Usually funds own it because they need to diversify. But if you're an individual investor who's more concentrated, then you would be avoiding defensive sectors like IT, FMCG, or
Okay.
pharma.
So you are saying that defensive like FMCG and pharmaceuticals also should be avoided at this point in time.
That's right. Those are places where you may see returns, but not more than what the market has to offer. That is going to come from either the interest rate sensitives in the large cap, the commodity cycle, maybe oil stocks, or it will shift towards a lot of mid and small caps where, because of the ongoing growth, valuations have actually cooled off, and search for those pockets, and that's where you'll get the big returns.
You mentioned metals will do well, Rohit, but is there any other sector that you are expecting to do well beyond the metal space?
I think IT, metals, banking, and autos, those like on the rate sensitive side. But if you move outside of that, I think the energy and defense spaces still continue to attract attention. Some of these stocks are very close to support levels, have picked up momentum. And I think those are, you see, the thing with the bull market is that the winning sectors don't go out of favor. They just continue to remain in favor. So a lot of people try to call out, that they'll go out of favor. But I think, energy and defense are going to remain in favor.
Okay, all right, Rohit. Thank you so much for joining us. Always a pleasure speaking with you. So that's the outlook on the markets from a technical viewpoint and how individual sectors could perform as well. We'll slip into a short break for now. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
Welcome back. As promised, shifting focus to the crypto space now. Manisha Gupta is here with the latest. Manisha.
Well, thank you for that. When you look at the overall markets, well, we have seen the sell-off just about continue when it comes to crypto. We saw Bitcoin trade at an all-time high of $126,000 in this year. Since then, we've not just broken 100,000, but we've broken 85,000 on the lower side as well. So very sharp declines continuing on to that one there. If you look at the overall market cap, that just holds about at $3 trillion right now. It's declined from 4.3 of a high in this year. The trading volumes also have seen a decline to almost 197 billion on a daily basis here. So 1.2 trillion is clearly wiped off from the crypto value in the last matter of 6 weeks itself. Overall markets, when you look at that, as you can see, the month-on-month declines have been quite sharp, and that has led to YTD declines also in sense of going strong there. Bitcoin, for one, has seen a decline by nearly 20% over the month, down by 8% in this year now. Ethereum, Solana, Avalanche, all down between 26 to 28%, and that brings the yearly movement or performance in many of these cryptos to the negative as well. So a 16% decline in Ethereum, but as you can see, 29% down in Solana, and 60% of a decline is what we are dealing with in sense of Avalanche. The big questions that the financial markets are now asking is on whether or not this sell-off in crypto will impact the other financial markets. Well, to take that point, stablecoin, for one, is a very big market. It's dominated by Tether, which has around $181 billion in reserve, and 112 billion of that is held in US Treasuries. The other one to look at also is the rival Circle. That as well holds nearly $24 billion in sense of US in case of stable coins there. The US Treasuries and in US Treasuries as well. When it comes to the US public listings, well, we saw almost 173 of them in 2025 till time. And from that, only 3 have been crypto companies that got listed. And when you look at the kind of funds that have been generated, of overall fund generated, the crypto companies got up nearly 3.3% of total funds. So the fear on whether this sell-off will spill over to other asset classes clearly seems slightly unfounded at this point in time. The other important number to watch out for is the European Central Bank in sense of holdings when it comes to crypto and institutions providing crypto custody as well. So that has seen an increase, of course. In 23, it was just about 400 million, which has increased to 4.7 billion in 2024, with an expectation that the 2025 numbers could be even higher on the side there. ETF holdings, well, that clearly has been a success story, what we've seen since Jan 2024. Out of 104 ETPs that were allowed, 367 is where we stand at this point in time. But in the last 4 or 5 weeks, we've seen huge redemptions come in for this one as well. So it's not just about retail or just about ETFs, but institutional holdings, corporate holdings. We have seen redemptions in crypto come across.
Manisha, thank you for that update. The sell-off continues within the crypto markets. Take a short break. When we return, we discuss the e-commerce trends with JM Financial Institutional Securities. This is Sachin Dixit on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's discuss the internet research space, the quick commerces of the world, and also Eternal, Swiggy, and other stocks in the sector. Sachin Dixit, who is the lead internet research analyst at JM Financial Securities, is joining us now to discuss some of these names. Sachin, good morning. Thank you so much for joining in. First up, tell us, what did you make of the quarterly results for this particular space between Eternal and Swiggy? What's your top bet and why?
Sure. So overall, I think in this space, what we are seeing consistently happen is that there is a sort of gulf appearing between how Eternal has performed and how Swiggy has performed. Interestingly, both of them do well when the competitive environment looks a bit more benign. Interestingly, we have not seen that happen. There has been a lot more news flow coming in from different sectors, from different companies trying to make a foray into quick commerce, which has resulted in probably both the stocks being slightly weaker in the recent 1 month or so. Overall, with basically news flow going in terms of how the competition is likely to be, that's something which will keep on impacting, I think, both of them. Eternal has been slightly more clear in that sense. They have not seen so much of an impact happen, largely coming from the fact of the balance sheet that they have and the track record that they have already delivered. Swiggy is coming from a place which is slightly behind. I think there is a catch-up that needs to happen.
Sachin, thank you for joining in. You mentioned catch-up, but the question being, has Swiggy hopped on to this bus a little too late? Because Eternal, for its quick commerce expansion, has been really aggressive over the last, say, 2 to 3 quarters. But Swiggy has been slow in trying to add more dark stores for Instamart and has now just approved yet another fundraise. So does that push them further behind in this quick commerce race?
It's tough to say, right? Logically, if you think of it, it's a very large market. Ideally, there should be more than, let's say, 2-3 players who should be making value out of this market. Eternal obviously has been more aggressive thanks to the capital that they have at their disposal. Swiggy, coming from a bit of a sort of, as you highlighted, they might be slightly late in terms of how they are catching up with the market trend. Which is also a function of the capital they have, and which is also the reason likely why they have gone ahead and taken that approval to raise more funds. It remains still to be questioned, like whether if they get the money, and if they get the money soon enough, whether they will go ahead and spend all that with as much aggression or not. Because logically thinking, it's a large market, there could be regional winners, right? If you look at broader traditional retail in India, there are region-wise winners, right? There are people who are quite popular in the West, there are people who do quite well in the East. So I don't think necessarily you need one single player to win across the country. So that's where the positioning stands. Obviously, we have seen so far that Eternal is one player which is trying to do a good nationwide play, thanks to what they have already proven in the past and how their unit economics are shaping up even in the recent few quarters. We obviously see that they are positioned quite well for that, but I believe there could still be people who might not necessarily win nation, but they might be a decent sort of play in their own defined regions and how so we go about it.
Okay, so that's about these food delivery platforms. What about some of these travel tech platforms? We did see some of them reporting good numbers, but that didn't happen with something like a Yatra. We did see Ixigo doing well. It's been quite volatile, right? Some of these stocks have done really well. What do you make of this entire space?
Sure. So I think what need to be understood about the space is that this is a space which does get benefited or impacted due to some seasonality coming into the picture, right? So if you look at Q2 results, right, a lot of these companies did see some impact coming from the limited supply, whether it's happening from the limited supply of airplanes coming into the country. A lot of our airlines are still struggling to get the right planes that they wanted and within time. And then there is the impact of extra rains. There was a lot of landslides that happened in the hills this quarter. right? So all those things do play out in the travel tech space. But if you talk about the couple of names that you mentioned, what is interestingly happening is that Ixigo coming from a more of a tier 2 sort of a background, which is where a lot of growth is coming from. There are a lot of upgrades, there's more travel that is happening in those geographies, is certainly driving more growth. Yatra also reported decent results, so which is why the stock has also reacted quite well. But I think you will keep on seeing in travel tech that there will be some seasonality which will happen, but there might still be consistent winners. Whether you look at MakeMyTrip, for example, right, which is a market leader, while they might not be growing at the same rate which an Ixigo might be growing, but if you look at the scale at which they operate, their growth is still commendable.
Sachin, I just want to complete this loop on the quick commerce and the food delivery companies. The biggest talking point has been the fact that they have been making losses. At least Swiggy had significant losses this quarter as well. Eternal is profitable, yes, but even on an EBITDA basis, but the net basis too. So because also there is a treasury income contribution to that. How long does the market wait for a company like Swiggy, let's just stick to that for that matter, for it to turn profitable? Because they have said that they will turn profitable sometime during FY 27-28. But would the market want to project that and reward it accordingly? Because the stock hasn't done much. It's back below its IPO price. So how long do you wait for companies to turn profitable and then value it accordingly?
I think interesting question. Honestly, since the last 4 to 5 years, which is when basically Eternal got listed as Zomato, right, July 2021, we have seen cycles happen. There were points of time where people were willing to give good multiples for growth. Then came a phase where everyone wanted profitability, which is when a lot of these names, whether it's Eternal, Policybazaar, Paytm, right, all of these companies started to focus more on profitability, and they delivered that profitability. Right, so there was that phase coming in. Then came quick commerce into the picture, and all of a sudden people saw that this is a vast market. There's a lot of growth that can come, and which is why people again started rewarding for growth. Right, so coming back to the question that you asked, right, Swiggy obviously at the time of IPO, people build in certain assumptions on how the environment will evolve, and that environment continues to evolve even today, right? If you look at how people are guiding towards dark store addition, right, Eternal did guide about when they will reach 1,000 dark stores. Then they upgraded that guidance further. Then they upgraded the guidance on terms of number of dark stores further, right? So in that sense, if you can deliver that trend, right, I mean, doesn't matter whether you are Swiggy or Eternal, right, if you can deliver the trend that you are able to deliver on that growth, and you are able to show that your unit economics is improving over a period of time. Obviously, right, in a phase in which you are expanding rapidly, you might see more impact happening on your console margins. But if that trend is delivered, I think market will reward. Right. Because I don't think people are playing this for 2-3 quarters. This is probably a longer term play.
Right. All right, Sachin, pleasure having you today. Thank you so much for joining in and discussing the latest trends in the e-commerce and, of course, the internet space. Hopping over to Mangalam now, who brings us the latest trends from the F&O space. Mangalam.
Well, it's a down day so far, no real worries, because we went within 30 points of a fresh all-time high yesterday, and then there was weakness that we saw on Wall Street overnight. The Asian market's not particularly doing well. So if you look at it that way, then, maybe the decline isn't as much. In fact, it's just a pause for breath. In fact, we've recovered from lows as well. A couple of data points that indicate that of the excesses yesterday, now there is signs of moderation. One, the India VIX, that has seen a bit of a spike. Now, it's been hovering around very low levels. So a spike in the India VIX actually is good, brings the risk back into the risk asset once again, and people don't get carried away. Secondly, the market breadth. It's actually continuously declining. Yesterday as well, we saw towards the end of trade, the market breadth had moved towards the area of decliners. And now as well, we have around 2,100 stocks which are in the red for about 600 stocks which are in the green. The only thing to track from here on would be the IT index. And if you look at the intraday chart out there, there has been a bit of a recovery. And every time the AI trade unravels globally, the IT index benefits. Why is that? Because when the AI trade was on, the IT index actually underperformed because the street believed that it's at the cost of Indian IT companies, or maybe, the AI boom will have an impact on the Indian IT companies. So if that trade is unraveling, the counter benefit of that would be the Indian IT stocks, and which is what has been visible over the last few trading sessions as well. And yesterday too, we saw recovery from the lows. And today's low on the Nifty is extremely crucial. Yes, we are down, but not out, because the low on the Nifty is still maintained at that 26,050 thereabouts mark. So telling you between 26,000 and 26,050, there is strong support. Put writers are fairly active, still at 26,100. So that's telling you that the bulls believe there is support at the lower levels. Though call writers have become a little more active as well at 26,100 and 26,200, telling you that as we move once again towards record high, there may be an element of some sort of supply coming in. The put call ratio yesterday, we pointed out, closer to record high, it had moved to 1.41, which was very high. So now that too has moderated to 1.04. So all these signs are good for the market pausing for breath before it moves further. And we are seeing a lot of short covering in a couple of individual stocks as well. Even though the market breadth is firmly in favor of decliners, we have names like PG Electroplast where the shorts are caught on the wrong side and they are covering their positions.
All right, that's the F&O update. Thank you so much, Mangalam, for joining us as always with what's happening in the F&O space. Slip into a break now. When we come back, our big story of the day comes up next.
Welcome back. Still 100 points lower on the index, but the big story of the day is the strong guidance and roadmap laid out by the Mahindra Group, as the company has stated that they will see 15 to 40% growth in the next 5 years. Sudarshan is here with the entire analysis. Sudarshan.
So it was like an investor day never before. You had 14 group CEOs presenting their outlook. So what is that outlook? Over FY22 to 25, the group companies have seen a growth of 25%. Going forward, over FY26 to 30, that outlook is in the range of 15 to 40%. Anisha and other group companies have talked specifically about growth gems. So in FY20, combined value of those growth gems was rupees 8,000 crore. Now the combined value has increased to 56,000 crore. That's a 7 times increase, and M&M's market share in that 56,000 crore is of 48,000 crore rupees. Now let's take a look about the outlook of the company-wise. So for SUV and LCV, they are expecting an increase of 8 times in the revenue, and that's the outlook from FY20 to FY30. For ILCV and electric three-wheelers, that's a 6-time increase in the revenue. For Mahindra and Mahindra Finance AUM, they are expecting an increase of 5 times. For aerostructures, 12 times increase. In realty pre-sales, 14 times increase, and for Mahindra Holidays, they are expecting to have 12,000 keys by FY30. So we have done certain calculation that group companies have given outlook from FY20 to FY30. So what about from FY25 level? So for auto, the current revenue is around 91,000 crore. If it increases as per the outlook, by FY30, it will increase to around rupees 3.9 lakh crore. For farm or say tractor, current revenue is around 35,400 crore. It will increase to 55,000 crore. For Mahindra and Mahindra Finance AUM, currently or as of FY20, it's 1.20 lakh crore, and it will increase to rupees 3 lakh crore. And for real estate or say Mahindra Life Spaces, currently pre-sales is of 2,800 crore, and it's expected to increase to 12,000 crore. And for Mahindra Holidays, total keys as of FY25 end was at 5,800 keys, and it's expected to increase to 12,000 keys. The group companies have talked about aspiration. Let's listen in what Anish Shah had to talk about growth gems and the outlook for FY30.
Auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly, and farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to growth gem. We are building on a very strong foundation, and we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade, from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespace is 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
All right, that's the Mahindra Group vision. That's the big story that we are tracking today. But time for a short break now. When we come back, Rupesh Shah from Symphony will join in next to discuss the business outlook, Q2 numbers, and a lot more. Welcome back. Symphony is the management on our radar. The company posted a weak Q2 with its sales declining, but the company remains confident that 2026 summer will not be as bad as 2025. Rupesh Shah, who is the Managing Director of Corporate Affairs at Symphony, is joining us now to discuss the quarter gone by, but most importantly, the outlook going forward. Mr. Shah, good morning. Thank you so much for joining in. It was a washout quarter, and you pointed out channel destocking and a lot of other factors that happened as well. Can you give us a sense of what top-line growth are you expecting in the second half? What have the demand trends been so far post the festive season?
Post-festive season, especially at a trade level, there seems to be some decent positive sentiments which was missing until then, and that is partly reflected in the advances and trade inquiry. So we expect that December quarter, of course, still it will be muted considering the inventory pile-up, but it should be better than the September quarter. As far as first 6 months of sales is concerned, of course, YOY there was a degrowth, but we have to also keep in mind summer of 24 was a blockbuster summer, so base was very high. Otherwise, September 26 on account of maintaining the market share in air cooling, and secondly, because of decent growth in adjacent category, that was the second highest top line in April to September period.
Mr. Shah, predicting weather trends has become almost next to impossible. Consider we used to assume that monsoons in the country would be between June to September. Today, this year around, the monsoons went on till November. But you are confident that the summer of 26 would be better than the summer of 25. Is it only because of the low base? Or you are confident that with all the reforms also that have taken place with regards to the GST rationalization and so on and so forth, there will be demand returning once once the season is back on the cusp of summer next year?
How the season will pan out, I think you already partly answered in your question that it is unpredictable to really assume how the season is going to be. But historically, there are not two back-to-back bad summer. That too, summer of 24 was bad for cooling appliances across the country. Sometimes what happens, in some parts it is good, in some part it is bad. So one is that historical trend. Secondly, the kind of the new models what we have launched for the mass markets, especially for semi-urban and rural market, that gives us some hope. Thirdly, the adjacent category, which now contributes 26% of our top line in trailing 12 months. That is another de-risking factor. And fourthly, we are continuously focusing on alternate channels.
Okay. So you have spoken about alternate channels in the past as well, how that could be a way of improving the overall performance. When we talk about other markets as well, Mr. Shah, what is the growth outlook in the US market? You did indicate that several major US retailers were in the final stages of having a conversation with you about your products. Do you think US market growth could help offset the decline that we saw in India generally?
Current year, there will be YOY decent growth to US sale. This is despite currently tariffs in place. And we are going to have some more dispatches in December and or March quarter based on the confirmed order from some large organized retailer. But obviously, that value and volume no way can set off the decline in domestic sales.
Would this opportunity be, Mr. Shah, the December dispatches that would come by?
No, what I say, right now we have some decent confirmed orders from US large organized retailer, which will be dispatched in December quarter and or March quarter, depending upon when they want the goods there. But we have some good confirmed orders. This is in addition to whatever we dispatch in June quarter through our Australian subsidiary.
Right, Mr. Shah, pleasure having you as always. Thank you so much for sparing time and joining us today. Wish you good luck for the second half of the year. And we touch base again after the end of this ongoing quarter. The management there of Symphony. Take a short break, but just before we do that, in a big week dominated by the Bihar elections, CNN News 18 continued its reign as the undisputed leader in English news. The channel stood significantly ahead of the competition combined, a feat testament to the faith reposed by the viewers in CNN News 18. Welcome back. The Nifty hasn't moved much since we began the show, continuing to remain around 100 points lower, still at that 130 point range at 26,050 on the downside and 26,200 on the upside. Take your leave on this edition of Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.